Hello guys, so in this video I just want to share a Wallstreetbets post, and it is magnificent. A lot of people have bias on Wallstreetbets. People understand because I used to have such bias, but this post really give me some insights that I never think about. So let's watch it together. Okay, so 10-year yields are spiking. What does it mean? It means it's so times. So you know how the Fed has been hiking interest rate to suck liquidity out of the system, reduce inflation. We all know it. And the mechanism of this is what investors see the high interest rate and they move their money into bonds, yes, while avoiding taking on new debt, avoiding new risky assets. This effectively deleverage the economy. Very good explanation. But over the last year of rate hike, for whatever reason, the investors simply don't believe the interest rate would actually stay high. Jerome Powell kept saying rates would be higher for longer, and analysts keep hearing rates cut by years, and this lead to crazy yield curve inversion. We have been saying that the long-term interest rate are significantly lower than the short-term interest rate, yes. This means that even though rates were hiking, we were not really feeling it that much. Yeah, we are all getting 5% in our long yield saving account now, but long-term debt was still relatively cheap. That's all changing now. The investors have finally woken up to the reality that Jerome Powell is serious about keeping rates high, not just tongue-in-cheek serious. So now even the long-term bonds are only being bought at higher yield. The long-term bond yields are racing to catch up with the short-term bond yields, effectively inverting the yield curve. And this brings us to our final destination of sucking liquidity out of the system. If you can lock in 5% fee return for 10 years, why would you keep your money tied up in a rental property that's only cash flowing 3.5%? Very good. I agree. It's even still worth it to have your money in the risk-prone stock market just to get a few extra percent return. No, you are going to cash out and buy risk-free bond. They are financially savvy boomer. She's going to start selling fast. This is the moment we are all been waiting for. The impact of the rate hike is finally hitting. Unleashing its true power. You may notice that the yield curve tend to rapidly invert immediately. 3 to 6 months before every recession. This is what the curve looked like in October 2000. And by March 2001, the dot-com bubble popped. It was a similar story at the end of 2007. So which will be the first domino to fall this time? Nobody knows for sure. But commercial real estate is on its deathbed, yes. Residential real estate is still overinflated, and banks are holding a bunch of old lower yield bonds that are pretty worthless ways now. I would expect the housing market to correct along with more SVB style bank collection. Don't fade the Fed in June, Powell we trust. That's the best article that I ever seen, and it's perfectly described a lot of issues in the current economy. I really hope you guys should really read it, and please make a sound investment decision. The interest rate is keep going higher and higher. If you are my subscriber, you should know it. And the winter is coming, trust me, and be careful.